Welcome to another episode of The Intelligent Speculator, where our purpose is to provide insights into economic and market movements that have been successful in helping us grow our wealth. And now, let's hear from the hosts of our show, Jesse Sanders and Lathan Fritz.
Hey guys, I'm your co-host Jesse Sanders. On today's show, Lathan and I are discussing why the Federal Reserve won't just be able to step in and bail us out next time we have a major event. That we can't just continue printing money unchecked without any consequences. So let's jump right in. Hey Lathan, how you doing today?
Just rocking and rolling over here, Jess. What is going on, my man?
Man, all is well on this end. Had the chance to go back and listen to our podcast from Tuesday, and man, the question there at the end is still the one that's been kind of the forefront of my mind. This stimulus efforts have been somewhat successful. And we touched on that. Guys, anybody that's listening now, if you haven't listened to last episode, I'd encourage you to do so, as we'll be kind of adding to that here on this call. But, in summary, it was, economy struggling, yet stock market has roared back.
Mm-hmm.
Why? What keeps us from rinsing and repeating next time, COVID bounces back, there's a resurgence, if we have to do some kind of shutdown, if there's, major negative news event that would trigger a sell-off, what keeps the Federal Reserve from doing what they just did?
Yeah, fire up the printing press, baby. Keep it going.
Right?
Let's keep the party on.
Right on. It worked. Everybody got money. Everybody's feeling good. What keeps us from just continuing on down that road?
Well, I think it's like anything else. Like it would be, you and me, there's a max capacity between our income and borrowing capabilities. It just so happens that the federal government has the central bank, the Federal Reserve, to print the money that it needs. But just like every country has discovered over the past 5,000 years, eventually you can't print your way out of a problem. Like eventually you got to pay back people money with money that actually means something and is worth something. So, money in itself isn't just wealth. It's supposed to be kind of like this unit of account that measures value creation. So like, when you go and, build a business and provide like some service for me, let's say, you serve me an ice cream cone. I find that valuable, so I give you the money, you give me the ice cream cone. Well, the problem is all this money printing hasn't produced necessarily anything of new value. It's just money that's been sent out there. And as a result of that, all that is doing is creating more paper or more digits on the computer screen, but doesn't do anything for that value component. And that value component is what's needed to pay down debt. So stuff that is owed to everybody else that we've promised in the future. And so, I think that at the core of it, it's like, you're thinking like, oh, the next time like the stock market has a crash, or, there's let's say a string of bankruptcies that occur because of COVID and everything that happened, and we were already in debt. So all these companies that were significantly in debt, go under over the next few months. Why not just fire up the printing press and pay them to kind of keep their employees and keep them afloat and, pay down their debt? Well, the problem is you can't keep doing that in perpetuity, because otherwise you get to the point of inflation and a loss of trust in the currency. And that is what even the monetary policymakers at the Federal Reserve know.
And so what would that look like? So you're saying lose, loss of trust, obviously inflation, everybody's for the most part familiar with that, but the loss of trust with the U.S. dollar. You speaking to American citizens, international community. Expound on that a little bit.
It would be everybody. It would be federal governments. So it's like if you see a government that it has a reckless fiscal policy and behaving very reckless, very much like a bank who sees like a lender being reckless, are you going to give them any more money or let them borrow from you anymore? At some point, you're going to pull the cord.
Yeah, you want to rein it back in.
Yeah, and so at that point, you'll have American investors saying, like, I don't really find the United States bond market very attractive. You'll have, governments and investors from overseas saying, we don't want to invest in the United States. And in fact, we're going to start liquidating equity holdings of American companies. We might start liquidating investments that we have in those countries because we don't trust what they're doing financially. So our investment is at risk. Okay. And so that can do two things. One, they start selling assets that are denominated in US dollars, or they just simply don't put any more investment in assets that have US dollars because of that concern. And so they'll go find somewhere that they think it's more safe and more protected. And I think that's what, when I say the loss of trust of the United States dollar, it's just not, American citizens where it's like, we don't trust the fiscal policy that's going in DC. I think it's much broader than that. It's the whole world. It's governments, it's businesses, it's investors, it's people that don't necessarily want it. And I think that's the biggest concern, that these policymakers understand that we have to be careful with how much we do, but, being in the situation that they are, they're going to do everything possible to try to get out of it.
So it's try to get as close as you can to that line without going over the line. You think that's kind of where they're at? They knew something needed to be done. How much more can they do? I guess that's what I'm trying to kind of get at. Is
exactly.
Does anyone know? If the trillions that have been printed now, do we have room to do it again, or are we one event away from this house of cards collapsing?
Mm-hmm. No, exactly. I mean, that's a great question, and nobody knows 100% the answer, right? So it's kind of like, a great example would be, at what point, the popular saying, the straw that broke the camel's back. But is it the millionth straw that finally breaks that camel's back, or is the millionth and one straw that breaks that camel's back? And we don't know. We just know if you keep putting straw on its back, eventually its back's going to be broken. So we have to look kind of like historically, what are some similarities between the past when these kind of like loss in currencies have occurred, and when did that event transpire? And if you look at kind of like the British of the 30s and 40s, in the 1900s, and if you look at the Dutch before that, you look at Japan in the 90s, typically it's around like 300% of debt to GDP. So what a country puts on an annual economic output in a single year. If their debt reaches about 300% of that, and that includes like government debt, personal debt, corporate debt, etc. If it reaches about 300%, that's usually the tipping point of where printing money no longer works. Monetary and fiscal policy can no longer get them out of the situation. And so,
okay, and it's not. Is there any kind of magic number to why that 300% figure is that, or is that just kind of what we've seen as consistent between other countries that have gotten to that point and then gone under?
I think just kind of consistently what we've seen from other countries, and I think a lot of it has to do with kind of, you have to have enough money to service debt, right? And at some point, you have to have enough money to service your debt, but also give people trust that, like, if you wanted to take on more money to get debt, I think it's probably that 300% threshold where people are no longer willing to lend it out, or people no longer trust the currency that is that much in debt. And so that's when they start shying away from it. And that's when I think it also becomes difficult for the country to start paying and servicing its debt. And I mean, even if you look at like the United States federal government, we're going to be running a $3 trillion deficit this year. I mean, just our annual deficit this year. I mean, to put that in perspective, it took, I think it was about 200 years for us to reach our first $1 trillion of government debt. And this past 12 months will be 3 times that, just in, not our debt, just our deficit that we're running at the federal government. Like, those are just like mind-boggling numbers.
So in 1 year, we've done more than what we did in the previous 200?
Yes.
Was it the previous 200, or was it a 200-year period?
Yeah, a 200-year period.
Okay,
so yeah. It would say from, 1776 to 1976. In fact, I don't even think our government debt had reached $1 trillion at that point. But just to put that in perspective, in terms of the insane amount of money that we're going through this year, that has never been tried before. And so even kind of looking at, like, what did the federal government do? We passed a $2.3 trillion relief bill. And, you know, if you could just print and spend all the money to get out of the problem, why not do 5 trillion? Why stop at 2.3? Right? Why not do 10?
So you think the 2.3 is very calculated with this maybe as much as we can get away with before just doing just irreparable damage?
Yeah, and it's the same thing with the Federal Reserve. They've already committed to $3.5 trillion of printed money, either printed or will print this year, and then another the $2.3 trillion corporate lending program. And again, you have to ask, well, 3.5, 2.3, you're 5-6 trillion. Why not go 10 trillion? And again, it's because they understand, like, we are close to the, like, you want to do enough to solve the problem, at least temporarily, but you can't just be like, oh yeah, this works in perpetuity, so we can just keep spending, because everybody knows, like, you cannot keep doing this over and over again at these insane levels. It's not going to work out, because you are going to have the rest of the world lose faith in you and your own personal citizens, businesses, etc. If you just keep doing this insanity. So you'll have trust loss, and that leads to a loss of investment in your country, into your economy, and eventually leads to massive inflation. Now, I don't think I don't think massive inflation is around the corner at the moment, because I think we're going into a deflationary time period where there's going to be a lot more unwinding and credit contraction as opposed to expansion. But I think after this deflationary period, we'll be set up very, very nicely is a bad way to put it, but we'll be in a perfect storm to see inflation increase significantly because of all this money creation that has occurred without any kind of increase in products or service or value creation. So all you're going to do is have a lot more money chasing the same amount of goods or service, or less goods and services.
And right now the deflationary period is kind of buffering that. So the cause right now is all the printing of money, but we may not see the effect until this deflationary period has kind of run its course, and that's when we see the inflation kick off.
Yeah, and I would say we're already kind of seeing inflation. We talk about the stock market, going off of the Dow Jones, for example, it's around like 26,000 today. In March, it was at 18,000. If the federal government and the Federal Reserve hadn't stepped in, dude, it'd be probably closer to 10 to 15,000 today. But because of all that money printing, it made people feel better. It kept people employed. It's keeping people employed. So people are fine with keeping money in it and putting more money into the stock market into equity markets. So you're already seeing an artificial inflation in asset prices that should be significantly more deflated than they are, but it's keeping them afloat.
So they're wiping the sweat off their forehead, saying, "Whew, we dodged a bullet on this one." But they're over the Fed, they're not throwing any parties right now either. You think they recognize the precarious situation that we're in? And sure, things seem to have recovered pretty well since March, but there's a long road ahead.
Yeah, because even like last week, Chairman Powell of the Federal Reserve, he came out and he said, we are in a very precarious position. We have no intention of raising interest rates anytime in the near future. We believe unemployment will remain high until about 2022. And again, this is just a forecast, and usually the Federal Reserve is a lot more rosy than actually occurs, and it was a pretty dire is a strong word, but it was pretty pessimistic, and the stock market, as a result, the Dow Jones lost 1,800 points in a single day last week as a result of that, because of that kind of very pessimistic outlook. And so it is one of those things that, yes, our monetary policymakers do know we are in a very, very dangerous situation at the moment. And for now, it has worked. But if there's, if coronavirus comes back, if there's a huge string of bankruptcies that occurs, if Italy defaults on its debt, or Spain defaults on its debt, or you have a Eurozone crisis, or if China and the United States start a trade war again, dude, there's so many unknowns that can pop this kind of this short recovery that has occurred up till now. And at that point, you have limited tools on how to fight that. And I think that's what probably keeps them up at night.
For sure. Well, let's just hope everybody plays nice. We don't have any trade wars. Coronavirus goes away. No, but for real, man, I appreciate the time talking on this. It'll be very interesting to follow. I enjoyed unpacking it with you. So looking forward to our next call here in a couple days.
Sounds good, brother. Take it easy.
Thank you for listening to this interview with Lathan Fritz and Jesse Sanders. We hope to see you next time, and remember to like and follow The Intelligent Speculator on Facebook, Twitter, and Instagram, where we are posting insightful nuggets of economic and market movements. And if you would like to get exclusive information, feel free to join the Intelligent Speculator Facebook group. Good day.